2026 will be the year everything changes for precious metals. Not because of manipulation or market timing, but because of mathematics that can't be ignored anymore. My models show silver hitting 180s per ounce and gold reaching $300 to $400 by December 2026. These aren't hopium predictions. These are calculations based on supply deficits, monetary policy failures, and geopolitical shifts that are already accelerating. I'm a precious metals analyst with 15 years of experience tracking these markets through multiple boom and bust cycles. I've seen the false breakouts, the crushing corrections, the media hype, and the quiet accumulation phases. But I've never seen a setup like what's developing for 2026. What I'm about to share is not financial advice. It is analytical projection based on observable trends, mathematical relationships, and historical precedents that suggest precious metals are approaching the most significant price explosion in modern history. Let me walk you through exactly why I believe we're heading towards silver at $180 and gold at $300 to $400, the timeline for these moves, and what could push prices even higher than these already aggressive targets. The supply crisis nobody's talking about. Let's start with the fundamental driver that makes 2026 different from every previous year. We're facing the first genuine supply crisis in precious metals since the 1970s. Silver mine production peaked in 2015 at 886 million ounces annually. Since then, it's been declining every year. 2023 production was 842 million ounces. 2024 dropped to 819 million ounces. Early 2025 data suggests we'll see production around 795 million ounces. Meanwhile, industrial silver consumption continues accelerating. Solar panel production alone consumed 173 million ounces in 2025, up from 91 million ounces in 2020. Electric vehicle manufacturing added another 87 million ounces. 5G infrastructure, medical applications, and defense systems are consuming silver at rates that didn't exist 5 years ago. The math is brutal. Industrial consumption plus investment demand now exceeds new mine production by approximately 180 million ounces annually. That deficit is being filled by above-ground inventories that are depleting rapidly. COMEX registered silver inventories have dropped from 180 million ounces in 2022 to 31 million ounces today. London Metal Exchange warehouses show similar depletion patterns. Even recycled silver can't fill the gap because most silver used in electronics and industrial applications is dispersed in quantities too small to economically recover. We're consuming existing silver stockpiles at accelerating rates while new production continues declining. This creates a mathematical certainty, either demand destruction through higher prices or physical shortages that force prices to levels where marginal supply becomes profitable and marginal demand gets priced out. Based on cost curves for dormant silver mines and substitution thresholds for industrial applications, that equilibrium price sits around $165 or $180 per ounce. That's not speculation, that's the price level where supply and demand mathematics balance. Gold faces a different but equally bullish supply dynamic. Total annual gold production is roughly 3,200 tons globally. Central banks alone purchased 137 tons in 2025, the highest level since 1967. That's nearly one-third of total production being absorbed by entities that never sell. When central banks of China, Russia, India, Turkey, and dozens of other countries are accumulating gold reserves while reducing dollar holdings, they're creating permanent demand that removes supply from commercial markets indefinitely. Private investment demand adds another 800, 1,000 tons annually through ETFs, retail purchases, and institutional allocation increases. Combined with jewelry fabrication and industrial uses, total gold demand now exceeds production by approximately 400, 500 tons per year. That deficit is being filled by central bank sales from countries reducing their gold reserves, primarily Western nations liquidating holdings to support currency interventions or debt management. But those sales are finite and declining as more countries become net gold buyers rather than sellers. The monetary policy catalyst. The fundamental supply-demand imbalance in precious metals would eventually drive prices higher regardless of monetary conditions. But 2026 will coincide with monetary policy failures that accelerate precious metals demand far beyond normal investment allocation. The Federal Reserve faces an impossible trilemma in 2026. They need to raise interest rates to combat persistent inflation, lower interest rates to prevent recession and support treasury markets, and maintain current rates to preserve what remains of dollar credibility internationally. They can't do all three simultaneously. Whatever choice they make will trigger geopolitical tensions in 2026, will provide the catalyst that transforms gradual precious metals accumulation into urgent strategic demand that overwhelms available supply. Current global conflicts are expanding rather than resolving. The Russia-Ukraine situation shows no signs of peaceful resolution. China-Taiwan tensions continue escalating. Middle East instability is spreading across multiple regions. Economic sanctions are proliferating as diplomatic tools become less effective. Each escalation drives sovereign entities toward assets that can't be frozen, seized, or devalued through foreign policy decisions. Gold and silver held in domestic vaults provide value, storage, and transaction capability that remains functional regardless of international political relationships. But 2026 represents a unique inflection point because multiple major powers are simultaneously developing alternative monetary systems specifically designed to bypass dollar-denominated international trade. The BRICS silver standard I have discussed in previous videos becomes operational in 2026. China's digital yuan continues expanding internationally. Russia and Iran are developing commodity-backed trade settlement systems. European entities are exploring euro-denominated alternatives to dollar-based correspondent banking. These are not theoretical future possibilities. They're operational systems launching in 2026 that will immediately create demand for precious metals reserves to back alternative monetary arrangements. When sovereign entities need precious metals for monetary system functionality rather than just portfolio diversification, demand becomes inelastic. They'll pay whatever price is necessary to secure the quantities required for their systems to operate effectively. Industrial demand explosion. The industrial silver demand explosion scheduled for 2026-2027 represents the most significant increase in industrial precious metals consumption since the electronics revolution of the 1980s. Artificial intelligence infrastructure requires massive data centers with unprecedented silver requirements for electrical connections, thermal management, and electromagnetic shielding. Each major AI data center consumes 25 tons of silver for construction and operation. Major tech companies have announced data center construction programs requiring approximately 340 tons of silver annually through 2028. That's 40% of current annual mine production dedicated to a single application category that barely existed 3 years ago. Electric vehicle adoption is accelerating beyond most projections due to government mandates, infrastructure development, and battery technology improvements. Each EV requires 0.08 1.3 ounces of silver, depending on the model and battery configuration. Global EV production targets for 2026 suggest 28 million vehicles, requiring approximately 30 million ounces of silver. By 2027, that number increases to 42 million ounces as production scales and individual vehicle silver content increases with more sophisticated electrical systems. Solar panel installation is experiencing exponential growth driven by government renewable energy mandates, declining installation costs, and corporate sustainability requirements. Each megawatt of solar capacity requires approximately 3,500 ounces of silver. Planned solar installations for 2026 total 847 gigawatts globally, requiring 296 million ounces of silver. That's 37% of total annual mine production for solar panels alone. Defense applications are consuming increasing quantities of silver for advanced weapon systems, electronic warfare capabilities, and aerospace applications that require silver's unique electrical and thermal properties. These industrial applications compete directly with investment demand for available silver supplies. Unlike investment buyers who can delay purchases if prices rise, industrial users must acquire required quantities regardless of price to maintain production schedules and meet contract obligations. My specific price predictions. Based on supply deficit mathematics, monetary policy trajectories, geopolitical developments, and industrial demand acceleration, here are my specific price targets for precious metals in 2026. Silver price. Progression, Q1, 2026, $95-110, current consolidation breakout. Q2, 2026, $125-140, industrial demand surge. Q3, 2026, $155-175, supply crisis recognition. Q4, 2026, $175-185, year-end target range. The silver price progression assumes gradual recognition of supply deficits combined with accelerating industrial demand and increasing investment allocation. The most likely path is steady appreciation with periodic consolidations rather than parabolic spikes, although supply disruptions could trigger gaps higher at any point. Key inflection points for silver. Well, gold's progression reflects its role as the primary monetary metal during currency system transitions. The price appreciation will likely be more consistent than silver due to deeper markets and more diverse demand sources, but potentially less explosive due to larger above-ground inventories. Key inflection points for gold. $2,200 confirms new bull market to mainstream investors. $2,500 triggers algorithmic momentum strategies. $3,000 represents psychological watershed that activates institutional allocation increases. Risk factors and upside scenarios. These predictions represent my base case scenarios, assuming current trends continue without major disruptions. However, several factors could drive prices significantly higher. Upside catalysts, major mine production disruptions from geopolitical conflicts, labor strikes, or environmental regulations. sovereign accumulation programs larger than currently anticipated, central bank coordination on gold-backed alternative monetary systems, industrial demand acceleration beyond current projections from AI, EV, or renewable energy adoption rates, currency crisis in major economies, forcing emergency precious metals purchases. Extreme upside scenarios. If multiple catalysts align, prices could reach silver $240 to $280, gold $40,200 to $800. These levels would represent genuine supply emergencies where physical availability becomes more important than price considerations. Downside risks. Global recession reducing industrial demand faster than mine production. Declines. Major technological breakthroughs enabling silver substitution in key applications. Central bank coordination to suppress precious metals prices through coordinated intervention, cryptocurrency adoption, reducing precious metals monetary demand. However, the supply deficit mathematics make sustained price suppression increasingly difficult regardless of demand fluctuations. Timeline and positioning strategy. The price appreciation will likely follow a specific timeline based on different demand categories activating at different price levels. Phase 1, Q1, Q2, 2026. Foundation building. Early adopters and technical analysts drive initial price appreciation as charts break key resistance levels. Mainstream attention remains minimal. Phase 2, Q2, Q3, 2026. Recognition. Industrial buyers begin competing aggressively for available supplies as lead times extend and availability becomes constrained. Financial media begins reporting supply concerns. Phase 3, Q3, Q4, 2026. Acceleration investment demand explodes as price appreciation attracts momentum investors, and allocation mandates trigger institutional buying programs. Phase 4, 2027 plus. Crisis. Physical shortage becomes undeniable, forcing price discovery through auction-style bidding for available supplies among users who cannot substitute alternatives. For positioning, I recommend accumulating physical metals during Phase 1 consolidations, avoiding leverage or trading strategies that depend on precise timing, and maintaining long-term perspective focused on multi-year trends rather than monthly fluctuations. The opportunity in precious metals isn't about timing perfect entry and exit points. It's about positioning before mathematical inevitability becomes consensus recognition. Conclusion: the mathematical certainty. 2026 represents the convergence of supply deficits, monetary policy failures, geopolitical tensions, and industrial demand acceleration that creates the most compelling precious metals investment thesis in decades. Silver to $180 and gold to $3,400 aren't optimistic projections. They are mathematical necessities, given current supply-demand imbalances and observable trend trajectories. The question isn't whether these prices will be reached.